I would say that we're already in the dollar end game. It began really in 1971, but it really accelerated in 2008. The real fundamentals of the market never really recovered. And this is something that I call the 2008 never ended thesis. In June, we had obviously like positive jobs report, but once you dug below the hood, you saw that 80% of the jobs were government and healthcare. We've become stagnant and we haven't really seen real wages grow for decades.
I saw a headline this week that said, if you watch a major sports event in America, you are seeing an ad for gambling every 13 seconds. 13
oh my
seconds,
God,
right?
really? Retail has just basically become a massive gambling addicted society. The unemployment rate now for college educated males is the same as non-college educated males. So getting an education is no longer proof that you will actually get a good job. Bitcoin's the true solution here. And I think that Bitcoin can genuinely save the world economy from a massive currency crisis.
Hello, everyone, and welcome back to the Bitcoin News channel. I'm your host, Rob Wallace, and today I am very grateful to be joined by Roberto Rios, aka Peruvian Bull. Roberto, how are you doing today?
Doing very well. How are you, sir?
Doing good. Yes, we are at the end of summer here, a time in the markets that are usually quite quiet. And there's been some rumblings. Is the Bitcoin bull market over? So before we dive into the Fed, liquidity, Trump, and stablecoins and all that jazz, why don't we talk about the current state of Bitcoin? What are you most bullish about Bitcoin here in August 2025?
So actually, I'm most bullish on the consolidation that we've been going through. I know a lot of people, especially on Fin Twitter, crypto Twitter, Bitcoin Twitter, have been really, pounding the table that this is like no other bull market. They've been bearish. They've been saying, we've been trading this essentially range bound zone of between 100 to 120K for like the last 4 or 5 months. And we haven't really been able to break out consistently, right? We had a brief breakout above 120, 121K about a month ago. And then we trended back below. We obviously just last week had a liquidation where Bitcoin dropped like $3,000 or $4,000 in the space of a couple hours. ETH dropped like it was widespread liquidation across the board. And they take this price action, right? This kind of kangaroo crab style market where we're just range bound as a bearish sign that there's just no more buyers. But if you actually look beneath the hood and you look at, data from like sources like Glassnode or Willy Woo, what's been happening is a lot of long-term holders have been offloading their coins in this zone between, 105 to about 115K. So, something, we obviously had that whale sells, what is it, 80,000 BTC or something like that. I think it was several $1 billion. There have been other OTC trades of that size also back in June and May. It seems like the long-term holders, the ones that were very, very OG Bitcoiners, we're talking, sub $10 Bitcoin owners, they have been really taking profits here. And that means that there's just this wall of resistance we have to get over before we move higher. And that's why we've kind of been consolidating. But what the pundits that I follow on Twitter are missing, in my opinion, is that this consolidation generally is actually a bullish sign. It means that the market is shaking out all the weak hands. And, Jack Mallers has that saying, Bitcoin will either scare you out or tire you out, right? And right now it's tiring people out. And so I'm just encouraging, keep accumulating, keep waiting, right? The thesis hasn't changed. And, we should be preparing for a larger move higher here, I think, in the next few months.
Do you think that this fall will be explosive, or are we going to continue this stair step up?
I actually think it's more of the stair step up. Again, you look at prior cycles, right? And we had huge bull moves in the space of just a day or two, especially on bullish announcement, right? The El Salvador buying Bitcoin announcement or the initial MicroStrategy plays, right? We had huge moves in the Bitcoin price. But now Bitcoin is a much more mature asset class. It has much more, paper derivatives and paper trading than before, which means that there's speculation on both sides, on both long and short ends. And so that means that a lot of the risk actually gets hedged out, right? A lot of the volatility starts to get hedged out because what happens is you have these vol arbitrageurs come in and basically trade the vol in order to capture a spread, but that by definition dampens because they sell the top, they sell runs, and they buy dips. And so, as this kind of institutionalization of Bitcoin continues, I expect the vol to dampen more and more. And like that steady, slow buying that institutions are known for to become the mainstay of the markets, right? I think Bitcoin in the future is not going to be primarily run by retail, actually, like the trading action. It's going to be mainly run by larger institutions, the Bitcoin Treasury strategy, for example. And then that means that, those players, obviously, with the billions and billions of dollars that they have, they're not going to front run their own trades. They're not going to be smash buying $4 billion in a day, because that will move markets. I know a hedge fund manager who was mentioning to me that there's only around $50 to $100 million of liquidity on either side of the bid order book, bid-ask spread, before you start to move things very, very rapidly. So if you're a large institution, and you have a couple $1 billion, you have to spread your buys out over days or weeks or months. You can't just go in and buy, wholesale as quickly as you can generally.
Yes, and as we're here right now, we see markets at all-time highs, right? The stocks are way up. We've got Nvidia worth $4 trillion plus. And a lot of this is due to the fact that we have had QE, stealth QE, throughout the last 15 years plus, right? So it doesn't seem like that up front, but when you look behind the hood, there's all these operations going on. And you have written the dollar endgame, the macro plumbing, what's going on here. But there's all these terms that are purposely confusing, I think, for the general public. So we've got QE, we've got the TGA, we've got the reverse repo facility. What do these things mean, and how can you explain them simply for the audience?
Sure. So, and stealth QE is a term that I made back in 2023, 2024. Other people have also used it, obviously. It's they sometimes call it stealth liquidity or quiet easing, right? I've been hearing it termed many different things, but essentially what it is back in 2021 and 2022, right? The Fed was facing a huge dilemma. They had ran $120 billion a month in QE, and they had basically caused a massive inflation wave, one that they, at least seemingly on the surface, did not expect to happen. And the reason why it happened was because of a truth of monetary plumbing, which is that when you do QE and you have no fiscal deficits or no large fiscal deficits, the created bank reserves and the created liquidity just circulates in the financial system. So it becomes, basically like money for banks to trade and to lend and to borrow against, which means that financial assets get juiced and asset prices go up, to a huge extent, right? This is what we saw from 2010 to like 2020, 2021, right? There was massive amounts of QE. And people like Peter Schiff were going on TV claiming hyperinflation, claiming that we're going to see massive gold price moves because of this 20, 30, 40% annualized inflation rate, and nothing happened. And it was because there was no fiscal deficits to pair with it. And the fiscal deficits is really what pulls the money from the banking system in the form of bank reserves into the real economy in the form of M2 money supply. So 2021 was the first time where we not only had quantitative easing and monetary accommodation on the Fed side, but we also had obviously like fiscal accommodation because of the PPP loan programs, the stimulus checks, all the COVID spending, all of that stuff. What that meant is that there was a massive wave of inflation, and the Fed had to fight it by raising rates. And that raising of rates and then eventually starting the taper of the balance sheet was very worrying to them in the sense that they could see that it was starting to cause problems. So September 2022, we had the gilt crisis and the yen crisis. March 2023, we obviously had Silicon Valley Bank, and then First Republic and other banks start to fail. And that was obviously an issue for the Fed because they realized that they were withdrawing too much liquidity from the system. And so some of these alternate tools that they had been storehousing, like reverse repo and the TGA, they started using as a form of like liquidity injection, but it's a liquidity injection that doesn't show up on the balance sheet. So you mentioned two examples, right? Reverse repo and TGA. Those are pretty easy to explain. Reverse repo is simply cash that is parked at the Fed in consideration for treasury bills, because a repo is essentially like a swap of a collateral and cash. And especially for the short-term bills, it's basically at 100%, so it's valued at par. So I park, $1,000 worth of 3-month T-bills at the Fed, and they give me $1,000, or let's say $999 worth of cash, right? Or no, sorry, if it's reverse repo, then I park the cash and I get the T-bill. And the benefit for the Fed is that now they have this huge storehouse of cash stored up on their balance sheet. And technically, if this gets drawn down, it's not their cash, right? It's the money markets funds and the banks and the brokers. It's those guys' cash. But it represents an extra liquidity storehouse. And when that gets drawn down, which it did, it got drawn down from 2.4 trillion to around, what was it, like $50 billion last week. It's been basically drained completely. That means that all that cash re-enters the system and it circulates and it bids up stock prices, because all that money is now back in the hands of the banks and the brokers and the investment funds that now can use it to go speculate. The other thing was the TGA, right? And so the TGA is also pretty simple to explain. It's just the Treasury General Account. It's essentially the checking account for the U.S. government. And this is an account that's actually held at the Fed. So while you and me have our checking account at Bank of America or Wells Fargo or JP Morgan, the federal government only banks with the Fed. And when they issue bonds, they sell those bonds generally for bank reserves. And then when they flow into the TGA, they magically, by the pressing of a button, become M2 money supply, because the Treasury needs to spend this money, right? It needs to go out and circulate in some way. And so that means that if the TGA gets built up, that means liquidity is draining from other parts of the financial system. And when it gets drawn down, it flows back into the real economy and also the financial system in the form of bank deposits. So you get more retail investment, you get more speculation, you get more options trading, because now all this cash is flowing to retail consumers who either invest it or speculate with it, or go out and spend it in the real economy. And so overall, that increases the amount of bank deposits and increases the size of the banking system and the total liquidity. So both those things have been those key, I guess you could call them stealth easing programs. And the TGA has also been drawn down significantly. It's back up to, I want to say 600 billion right now. But at its peak, it was at almost 2 trillion. So, I expect them going forward to continue to use these tools, especially the TGA, as a way to essentially add stealth liquidity back into the system without increasing their balance sheet on paper.
And looking back at that period 2 years ago, when things were on the rocks with the European bonds and, of course, the regional bank crisis here, do you think that we were really close to something systematic happening?
Oh, absolutely. Absolutely. So if you look at interbank, I have a chart of interbank borrowing, net cash from commercial banks, and it exploded from around 300 billion to 800 billion in just 2 months in the space of March to April 2023. So what that tells you is that not only did obviously the Fed start the BTFP program, but the banks needed to start borrowing from each other at a rate that they haven't done so since 2008. And actually, if you look at the top tick of that borrowing figure, it's higher than 2008. So if the system wasn't in trouble, then why are the banks borrowing from each other more than they were during the great financial crisis, right? Doesn't make any sense. So clearly things are under stress, and they're still under stress in many ways, but it's just happening all beneath the hood. It's all happening, in the background, in the plumbing of markets. And the Fed is essentially committed to helping these banks or helping these institutions with these stealth measures. They don't want to go out and announce, hey, we have to do a bailout, right? We have to do some sort of custody or roll up of these banks. They would rather say, okay, we're just going to do BTFP program. We're going to do a new discount window program. And we're not going to announce who's taking the credit. We're not going to announce who's taking the money, but we're just going to give money and value their bonds at par, just, because we want to be worried about the stability of the system. But again, they'll never just outright say that they're doing essentially like stealth bailouts. But overall, that trend is very concerning, right? Because that means that our banking system is not as robust as it should be.
And as Bitcoiners, we usually don't like the Fed, right? We're not fans of the Federal Reserve System, creating money out of thin air and devaluing our currency, of course. But when you see all these crises that have just lined up from 2008 up until today, and yet it's been sort of smooth sailing in some ways. So does Jerome Powell deserve more credit than we give him?
I would say sure. Again, if you look at this look at this objectively and outside the lens of the neo-Austrian economists that Bitcoiners follow, right? Sure, the Fed is I think a bad entity, right? They're the ones who create inflation. They're the ones who bail out these banks when the banks are clearly making mistakes that normally in the free market should be punished with bankruptcy. But take the tack from the monetary policymaker point of view. They're going to try to do everything in their power to save the system, right? They have a lot of vested interest in saving the system, and they're not dumb. As much as Bitcoiners want to like pound Powell or these people for being stupid or ignorant, they're really not. They're actually extremely intelligent, and they know what they're doing. They have experts at the Fed who have done extreme and extensive work on monetary plumbing, like Zoltan Pozsar. And what they do is that they try to find out, again, where the problems exist and front run the problem and be there before it actually blows up. And to be fair to them, if the system did blow up, again, the Bitcoiners kind of misunderstand how severe that would be for the average person, right? Maybe not the Bitcoiners who hold a lot of coins, but your average mom and pop who owns a store in the Midwest and they have their cash in their regional bank. If all of their money disappeared tomorrow and their home equity disappeared and their real estate and their stock portfolio went down 90%, that would cause an immense amount of pain across the board. And it wouldn't necessarily endear people to Bitcoin, because if Bitcoiners came out on top, right, they would be seen almost as like, pariahs, as people who just profited from this collapse. So Powell deserves more credit than what he's due. I think right now he is making a mistake with taking so long to lower rates, but his navigation of the 2023 crisis was very, very good.
And so all these moves, as you say, is just kicking the can up the stairs, prolonging it and making the situation worse in the long run. But it only ends in one way, right? With fiscal dominance and yield curve control. So explain what the world looks like under fiscal dominance and YCC.
Sure. So I actually wrote a Substack piece called Stuffing the Coffers back in early 2024. And what the piece was trying to get at was essentially the fact that the further not only has the Fed done these secret QE programs and secret self-liquidity programs with reverse repo and TGA, but they have also engaged in other forms of self-QE involving the banks, making the banks buy more and more of the Treasury's assets. And this has actually been going on for decades, right? Like you could argue that this actually started in 2008, and then obviously in 2012 with new banking regulations like Basel III, with the 2014 money market refunds or renewal of regulations from the SEC. Those forced money market funds to be majority Treasury bill holders. You also have obviously the letters from ISDA, which is the International Securities and Derivatives Association, which is essentially all the large banks and brokers, that was asking for permanent SLR exemption after COVID-19, basically meaning that they could own treasuries without any capital held against them in order to increase the amount of treasury debt they could hold without impairing their balance sheet. And so all those are signs that like the banks have been moving towards this, I call it the suicide pact with the Treasury.
I wanted to briefly interrupt today's interview to give a big shout out to our lead sponsor, Rhino Bitcoin. Rhino is the all-in-one Bitcoin super app built by Bitcoiners for Bitcoiners. Buy or sell instantly. Send sats anywhere on the Lightning Network. Withdraw straight to cold storage. Even turn sats into gift cards or link to a Casa multisig, all within one sleek interface. And Rhino is just warming up. Soon, you'll pay bills, borrow against your Bitcoin, and save for retirement, all without leaving the app. Download Rhino at rhinobitcoin.com or tap the link in the description below. Use promo code BitcoinNews and Rhino will drop you $10 of free Bitcoin into your account today. Secure your stack with Rhino Bitcoin and enjoy the rest of the video.
The Treasury is in this serious debt situation, right? It cannot be understated. There's $37 trillion of debt. There's over $1 trillion of interest expense annually. There's, we have a weighted average of 3.3% of interest on the national debt right now. And if it gets to 5%, we'll obviously almost double the interest expense. And we also have obviously, a funding problem especially on the long end. And so that means that the banks have been taking the brunt of new treasury issuance. They've been buying and buying and buying and buying more and more debt and loading themselves up. But all this means is that the banks are now more dependent on the treasury and the treasury bond prices than ever before. And so what happens to the treasury matters for the banks. And so the banks have a vested interest in trying to prop up the treasury. And as this cycle continues, you can clearly see how it's a feedback loop where the banks buy more and more treasuries, the treasury gets more and more debt, then that means that the banks have to buy more and more because, again, if they let the bonds fail, then that's their portfolio, right? That's what killed Silicon Valley. And so the banks just become essentially like mini Federal Reserves. They become, privatized versions of the Fed that just swallow massive amount of debt. And your deposit in your bank becomes essentially just a treasury bill, right? It becomes a proxy for treasury debt. And that means that the fiscal side, the dominance, right, becomes not only just like a dominance, it becomes a hegemony. It becomes a complete and utter control of the system because everyone now is dependent on it. Not only the Fed, but all the commercial banks. And again, that means that treasury policy guides everything. So that's what the term fiscal dominance means, and that's what Lynn Alden means when she jokes around that nothing stops this train. I'm sure you've seen that meme online. She's basically saying that what happens for the treasury is what's going to drive, or what's happening to the treasury is what's going to drive markets and what's going to drive the rest of the system from here on out. Because the treasury is the main one that they're all reliant on for, asset price stimulation, for preserving their portfolios. So that means the Fed is going to ease when the treasury needs them to ease. The Fed is going to cut rates when the treasury needs them to cut rates. And if the Fed doesn't, then the Fed risks blowing up the whole system. And so they're kind of tied together in this suicide pact, this, golden handcuffs, if you will. And any way of cutting themselves free gets more and more difficult as time goes on.
And before Trump got into office, there was all this talk of this short-term debt that needed to be refinanced immediately as soon as he got in. But we are, 6-7 months into his presidency, and they seem to have been able to accomplish that successfully, right? There's been no bond auctions that have blown up, at least to my knowledge, since he's been president again. So how is that effort of refinancing the debt going as of right now?
It's going, I would say it's a moderate success. So you are right. There haven't been any complete disasters, although there were a couple 20-year and 30-year bond auctions that had pretty high tails, which means essentially like they had a lower bid to cover ratio and they had less demand than was expected, especially on the long end. But on the short end, the demand is still there. And in fact, in many ways, the demand is actually growing. So something I've been talking about, which you alluded to, is the stablecoin strategy, which has been followed by Besant and Lutnick, which is to increase adoption of stablecoins, especially globally, and encourage the usage of those cryptocurrencies in order to drive more and more funds into the treasury. Because obviously, as stablecoins are, and as they're currently regulated, and as they will be increasingly regulated in the future, they own majority treasury debt as their collateral. So when you go out and buy $100 worth of USDT or USDC, the institution behind that, the custodian, right, Circle or whatever, goes and buys $100 or $99 worth of treasury bills. And so that means that they become a guaranteed buyer of treasury debt. And that gives the government a source of funding, which is desperately needed. The estimate is around $2 to $3 trillion of funding can be added in the next even like 5 years with this increased stablecoin adoption. And since 80% of all stablecoins are traded outside the United States, this is actually more of like a quasi euro dollar, quasi global dollar system that is kind of self-reinforcing, right? If they're able to get other countries to adopt stablecoins in the same way that the U.S. is adopting stablecoins, then they can create external buyers for U.S. debt again, which is something they desperately need.
And do you think that these stablecoins are really just a CBDC by another name? I mean, do you think that they're useful? I mean, for the third world, of course, you don't have a bank account, but you can use a stablecoin to purchase things. But it just gets you part of this dollar system. It increases dollar hegemony, of course, and they can just shut it off at any time, right? And there's no privacy. They can see where it's going. So what's your take on that?
I would agree with that. I would agree with that, and I'm not sure if you've done more deep research on that, but if you look at the way stablecoins are generally structured, right? They're ERC20 tokens, so they're built on the Ethereum VM, and they're also generally centralized issuer, and they have to be because you need a centralized custodian in order to not only obviously custody the funds but redeem the funds. So when you go and redeem your USDT, USDC, you do it through an exchange, right? Generally, and that KYC exchange, they get credited when you send them USDC or USDT and they burn it. They get credited with dollars into their bank account via wire. That's not possible with a decentralized issuer system, really. It's only possible with a centralized issuer. And so that means that the way that they're structured and the way that they're coded is essentially basically like a centralized CBDC style coin where there's one person, one singular node that is ruling above all the other nodes, and that can actually censor people, right? We've seen that with ETH even. There were 52%, 53% blocks of ETH were OFAC compliant back in 2023 and 2024, which means essentially they were censoring transactions that the Treasury didn't like. But that also means that, again, all these stablecoins could be turned off at the press of a button. If they know your address and they think you're doing something bad, if you're tweeting pro-Second Amendment stuff or anti-government stuff, or you're promoting things that they don't like, they can turn off your stablecoin wallet pretty easily. And they can even do things pretty Orwellian that we would consider that China has been working towards, which is they can create negative interest expense. So meaning you would put $100 in and you'd be losing 4% a year just by holding them in your wallet. So it would essentially force you to spend. They can also do obviously mass confiscations. They can say we're going to take 20% of everyone's balance. They can do fee adjustments, or they can do supply adjustments. So they can say, look, we're going to print 20% more USDC, so your USDC will become less valuable. So you have to go out and spend it or go do things with it. There's a lot of things they can do. And that essentially is a backdoor, I think, for the governments to essentially create CBDCs and to seize more and more control, which is why we have to be careful. There are obviously use cases for stablecoins, but we have to keep the wall up between private enterprise and government. And that's why I'm not so supportive of the idea that all the stablecoin issuers just buy treasury debt, because that just puts them in bed with the largest player out there, which is the U.S. government.
And it also just shovels all of this debt onto the backs of people in the third world, right? So could you see other countries being like, no, we don't want USDT or USDC being used in our country because this just allows the U.S. government to just, again, shovel this debt onto our citizens?
I would agree with that. Yeah, a lot of U.S. government or a lot of foreign governments may not want that to happen. I think, though, that the problem is because the U.S. dollar is a world reserve currency, it's used so much in international trade. And if you look at comparatively on the retail perspective, right? If you're a investor in Venezuela, or if you're a cattle herder in Argentina and your currency's falling at 40% value a year, you'd rather hold USDC or USDT rather than hold your own currency. And if exchanges are using ways to bypass the local government regulations, it's kind of hard for the government to stop you from that local government from owning, USDC or USDT, because they don't have control over the central node, which is in the U.S., right, which is that circle. And so that means that it can be a way for the U.S. government to try to stuff debt onto all these poor countries and these poor retail investors without them knowing it. But I will say, on the pro side, this is the least risky form of debt, right? They're not buying 30-year treasury bonds. They are buying 1 month and 3 month T-bills. So all things considered, it could be much worse. But yeah, I agree. This is almost like a form of financial warfare. It's a financial hegemony. These are steps that they're taking to try to preserve the U.S. dollar's status as a world reserve currency.
And keeping a global lens, just this week, we see France and the UK come out and say that they might need an IMF bailout. And we've also got crazy stuff going on over in the Japanese bond market. So from the global perspective, what do you see going on? And do you think that these countries are on the brink?
I think they are. So there's a couple different, things going on. Obviously, you touched on 3 countries, which are in vastly different situations overall. But I'll touch on Japan and the UK because those are the worst, in my opinion. But the French 20-year OAT yield, which is their bond, hit a 16-year high just this week. So they're also in dire straits, obviously. But the British government is currently facing, obviously, a massive immigration crisis. They have a huge fiscal problem, and their bonds have been above 5% for months now, which is extremely dangerous because, these are levels that haven't been seen since the 2022 gilt crisis blow up, which forced the Bank of England to do emergency interventions in their bond market. And that was also coincident with the time that the pound essentially fell to parity with the dollar, and the euro fell to parity against the dollar as well. And that's another sign that, right, like these countries their economies are actually much weaker than most people give them credit for. The youth unemployment rate in Britain is, something north of 25%. So it's extremely, extremely bad. And there are, every year my intern is from the UK, and he was telling me that there are 600,000 or 700,000 postgraduate students who are unable to find work. So if that's any indication, if people with a high amount of education can't find work, then generally your economy is in poor straits, right? So the UK is in a bad spot, and so is Japan, right? They're at 260% debt to GDP, and their 30-year and 40-year bonds are both hitting all-time highs. I didn't check the 30-year this morning, but last I checked it was at 3.23% or so, which is, again, all-time high. It's been hitting an all-time high almost every single day for like the last 2 weeks. So it's just been trending steadily towards I guess you could call it a sovereign debt crisis. And all this is being driven, in my opinion, partially by the actions of the Fed. Because the Fed has been taking this tact of raising rates very high and keeping them very high for a long period of time, it forces other countries to normalize rates with the Fed unless they want to see their currency start to blow out, right? So this is what happened to Japan in 2022 when the Fed started hiking. Japan kept interest rates pinned at zero, and that meant that Japan saw their currency blow out from 100, 110 to the dollar, the yen, up to 150 within the space of like 6 months. And the yen is still at around 150, so they still have an extremely weak currency. So all these countries are facing this dilemma. Do you raise rates to equalize with the Fed so that you don't lose out on the currency side? But if you do so, you risk blowing out your bond market, or do you keep rates pinned and then blow out your currency? So it's a choice of either to save. You can save the currency or you can save the bond market. You can't save both.
And if we look back, we can see that everything fundamentally changed in 2008. That's when my eyes were open. I was a college kid. I think you were a little bit younger. But since then, we've been living in a la-la land. And they've done such a good job of keeping these markets afloat and keeping the illusion alive. But in reality, this has real world effects on people. And so our age cohort, we are dealing with being locked out of the housing market, having questions if people can afford having a family, all this stuff. So let's talk about how the world has changed since 2008 and the real world effects on our generation.
Sure. So since 2008, we've obviously seen a sea change, not only in, I would say equity markets, meaning like what has come to drive markets now is not so much fundamentals. It's more the liquidity picture and front-running central bank intervention. But there's also obviously been a sea change in the real economy, right? In the housing market, in the actual job markets, in auto and industrial construction. If you look at, for example, things like total industrial manufacturing output in the United States, it basically peaked in 2008. And even today, as we sit like 15 plus years later, 17 years later, it hasn't gone higher. And if you look at things like labor force participation peaked in the early 2000s. And right now it's sitting around 66 or 67%, which is the same number it was at back in October of 1977. So if that's an indication, our economy and our, the real fundamentals of the market actually have gotten substantially worse, and they never really recovered. And this is something that I call, the 2008 never ended thesis. Robert, who goes by Infonomics on YouTube, has been calling it the silent depression thesis. And he's actually been beating the drum on this and finding even more data points, which is great. So I highly recommend go check out his content. But he points out, for example, that the median real wages have basically stagnated since 2008. Productivity has gone up, but overall wages haven't changed. If you adjust unemployment for total labor force participation, meaning like the way unemployment is calculated is in my opinion incorrect, because it's essentially they can change the pool of workers that they consider employable. So if you stop working for more than a year, they cut you out of the statistics. But if you include all the total actual employable people using a metric from prior to 2008, similar as you would do with shadow stats and inflation, you find that real unemployment is actually around 20%. So it's not 4 or 5% like they say. It's many times higher. And that means that, again, the real economy is basically been stagnant. And what's been really driving growth, as we think of it, has been the stock market, right? Has been speculation, has been asset price accumulation, wealth accumulation from asset price gains, and the use of those wealth gains into areas like AI or crypto or, industrial manufacturing or some key area that they still think can juice some returns, private equity. But overall, the economy hasn't grown to the same extent. And this can even be seen right in the jobs numbers, right? Like in June, I believe we had obviously like a positive jobs report, but once you dug below the hood or beneath the hood, you saw that 80% of the jobs were government and healthcare. And if you look at the major employer in every state, there's a really stark contrast map where you see 1990 to now. And 1990, the major employers in each state, it's like, Boeing or Walmart or, Toyota or Ford, like some manufacturing giant. And then nowadays, 80% of the states, it's healthcare. It's, Blue Shield, Blue Cross, or it's Kaiser Permanente, or it's one of these large healthcare insurance giants that owns a bunch of hospital networks and has all these people working for them. And so if that is any indication, right, like the economy has become sicker and more diseased, not only in obviously like literal terms in the terms of the population, but also in terms of economic growth. We've become stagnant and we haven't really seen, real wages grow for decades, which has been immensely depressing for especially the Zoomer generation who has been left behind.
And these fiat games force everyone to become a speculator, right? As Saifedean usually says, you got to have a job where you make your money, and then you have to have another job where you learn how to invest it. And a lot of people aren't even investing, they're just gambling. I saw a headline this week that said, if you watch a major sports event in America, you are seeing an ad for gambling every 13 seconds. Every 13 seconds.
Oh my God, right? Really?
Yeah. And so, between the sports betting and the meme coins, can you talk to that, to the gambling addiction that seems to be a part of late game fiat?
Absolutely. So I actually talk about this a little bit in my book, but essentially what happens is when you create, especially for young men, right? When you destroy the ability of young men to get gainful employment through work, through through education even, right? Like if you look at the unemployment rate now for college educated males is the same as the unemployment rate for non-college educated males as of last month. And so that's a shocking stat. And that's proof that like this, getting an education is no longer proof that you will actually get a good job. And when you take away those opportunities from those young men, they generally turn to despair. They turn to depression. And the way they cope with that depression is with, increased drug use, increased disassociation via video games or weed, and gambling, right? Because if you're only making subsistence amount of money and you have a couple $100 each week, you know that you're never going to be able to save your way out of poverty, right? You're never going to be able to just slowly gain your way out with eating avocado toast or walking to school or whatever it is. And so what you do is you just go out and buy meme coins. You buy zero DT options. That's another metric, right? The amount of short-term option plays that have been going on in the market has increased by like 700% in the last 5 years. So that's another metric to tell you that, like, and it's mostly retail too. Retail has just basically become a massive, gambling addicted society, right? They've moved to become so despaired that they're like, if I win 10 grand, 20 grand, then I'll finally have some money that I can go play with. But this $300 is worthless otherwise. So I'm just going to go gamble it away. And I kind of don't care if I lose, because like, what else could I lose? What more could I lose? So again, you look at every metric and you're right, like between meme coins and zero DT options and stock options and overt gambling, like, sports gambling, like you said, or app gambling in some way, or casino gambling, retail has just become, addicted to this form of escapism.
And on the other side of that coin is Bitcoin, right? The best savings vehicle in the world. So before we get more into Bitcoin, I'd like to ask you your orange pill story. How did you become a Bitcoiner?
Sure. So actually, I have kind of an interesting story, because I was fudded out of Bitcoin in 2017, unfortunately. I was following macro very closely. I was doing a ton of macro research, listening to podcasts, reading books, studying finance and economics at university back in 2016, 2017. And one of the books I read basically made the point that Bitcoin has a 7 transaction per second, hard cap, and Visa does 70,000. So they said there's no way that Bitcoin can be a global reserve currency or be any sort of currency, because no one can use it. It doesn't have the transaction throughput. And at the time, I didn't understand what layer 2s would be. I didn't understand how the Lightning Network could work. I didn't understand layered money, as Nick Bhatia points out. And so I just said, okay, like that's true. I'm not going to buy any Bitcoin. I sold everything I had. Unfortunately, I bought Bitcoin around like $2,000. I sold at like 18,000. So I made a 9x, and I thought I was such a genius back in 2017. And then I stayed out for years. And it wasn't until 2021, with the GameStop run up and then the freezing of the buy button, that I decided, I was like, oh my God, this system is really broken. And I'd already been down the Austrian economics route, and I'd already been a big gold buyer. And I had a couple friends that were, especially one, Ben Wehrman, who's a huge Bitcoiner. He was like, dude, you're already 80% of the way there. You just need to read these few books and you'll be getting it. And so he sent me some podcasts. And by April 2021, I was buying Bitcoin wholesale, and I had joined the Orange Pill movement.
Nice. So you've seen it change since 2017 through 21 to today. What's your current outlook on the institutional adoption of Bitcoin? Do you think it's been healthy so far, or are people getting complacent and jaded with the new Wall Street entrance?
I think some people, again, like, people misunderstand the risks and the rewards, right? Some people say incorrectly that, Blackstream owning an ETF, BlackRock owning an ETF, right? IBIT is like the worst thing to happen to Bitcoin. And I disagree, right? If this thing is going to take on nation states, you best believe it better be strong enough to take on an ETF, right? Ownership of the coins doesn't equate to actual voting power in the network. And even if you do own a lot of nodes, as we saw with the block size wars, you still can't change the network. It's extremely sticky and extremely hard to change, which is a good thing. That's the selling point of Bitcoin, right? A lot of the ETH maxis and a lot of the crypto maxis will tell you that you need to have the money change every 5 minutes, and that's exactly wrong. You want the money to be stable. You want it to be secure. You want it to be unchanging. That's the nature of money itself, right? You can have your securities change. Sure. You can have your stock decide to, the board decide to make a new investment or a new move or pivot the business, fine. But money itself, the measuring stick by which we value economic activity, should not be changed. But overall, so I think that the ETFs are a good thing in the sense that they're actually, providing buying power to Bitcoin. There are some concerns, however. I would say one of the bigger concerns is paper Bitcoin, right? These Bitcoin treasury companies that are launching and buying a bunch of Bitcoin and then not disclosing how much Bitcoin they actually own and not showing proof of reserves, it's making me worried that what these Bitcoin treasury companies are doing is actually just buying paper Bitcoin, buying Bitcoin IOUs. And so that would mean that, not necessarily like, obviously Bitcoin would survive even if those companies collapsed, but it just means that those companies are being irresponsible and not fully vetting their own reserves, or they're not at least fully vetting them to us, right? I would say another obvious concern for me is and it's becoming less of a concern nowadays, but it's the shutting down of, on ramps. So similar to what we saw with GameStop, if the government saw Bitcoin as a threat, they could shut down all the KYC exchanges. And despite what Bitcoiners say, right, that would deal a massive blow to the Bitcoin community. I'm not saying we couldn't overcome it. We couldn't use non-KYC or decentralized exchanges to trade, but it would make it much more difficult, right? If you had a bunch of fiat and you needed to offload into Bitcoin, you would have to move to basically like in-person transactions or offloading it into USDC or USDT using a tumbler and then moving it to some decentralized exchange and buying Bitcoin. It would just make the whole process way more complex and increase friction and reduce the amount of retail that would probably be buying Bitcoin and just lengthen the amount of time it would take to increase Bitcoin adoption. So those are the main concerns I have. But overall, I think, there's no way Bitcoin goes from zero market cap to the global reserve currency without going through some institutions. I think anyone who believed that, any of the cypherpunks who believe that, were just completely idealistic and pie in the sky. There has to be some institutional adoption. Obviously, we don't want them controlling the nodes. Obviously, we don't want them controlling the miners, but they have to be invested in some way and be, interested in furthering the cause of Bitcoin and furthering the adoption and furthering usage of the actual currency.
And speaking of Bitcoin treasury companies, I mean, they were the talk of the town last winter, spring, but now the majority of them have fallen on very hard times. And do you think that new life will be breathed into them come a Bitcoin rally, or is this fad already seen its day?
I think that's a good question. I think it still has some legs, but I think that the long-term thesis is that as more and more companies come in to be buying Bitcoin, this becomes less of a novelty and more of like just a standard, right? So if every company goes out and buys Bitcoin, then the Bitcoin treasury strategy isn't anything unique and isn't a selling point that investors will be buying into because everyone's doing it, right? That's similar to saying, oh, our company uses the internet. Our company has a website. Our company uses Slack for communications. And everyone else does. So you're not special. So I do think it might have more legs, especially with the Bitcoin rally, but I think that the incremental price gains it's going to get are going to diminish and diminish and diminish. So their premium over Bitcoin is going to start to compress. And probably in a year or two, it's going to get to the point where, if adoption continues and if the price keeps rising, especially if it does that slow and steady grind higher that we saw, earlier this year, then that means that we're probably going to be seeing a slow dying of the Bitcoin strategy. And that doesn't mean that the companies themselves die, right? If MSTR can finance the debt it's taken on and it can pay off all the converts with, proceeds from ATMs, then they can hold on to all the Bitcoin they made. So they basically made their bag, they profited from the strategy, and now they exit with 400,000 Bitcoin or whatever they hold, right? But it's not a game that can be continued forever because just by nature of getting more adoption, it just means that more people are going to be doing it. So I think in the long run, it's going to be phased out.
And one Bitcoin treasury company that's close to your heart is GameStop. They made the announcement back in May that they had purchased over 4,000 Bitcoin and they had all this cash laying around. We thought that they were going to be some huge name in the space, but since then it's been crickets. So what happened there?
Sure. So GameStop, actually, I've been encouraging them to be buying Bitcoin for years, as you can imagine. Like once I got the Bitcoin thesis and as a GameStop investor, I was very, very bullish on them using Bitcoin, especially in the form of, some sort of online marketplace, right? They started in 2022 with a crypto marketplace, an NFT marketplace run on Immutable, which is basically like an ETH, it was a loop ring layer 2, and it failed spectacularly. There were a couple $1 million worth of NFT volume every single week on it back in 2021. And then starting in 2022 and 2023, it just completely died off, and they eventually shuttered the entire NFT marketplace and that entire gaming, side of GameStop. And I had been encouraging them, go out and buy some Bitcoin, go out and start using Bitcoin in the stores, start allowing people to redeem their games in Bitcoin or to get DLCs or to get skins with sats. Like that would be a great feature I'm sure Bitcoiners would love as well. and they just kind of ignored me. I even tweeted, if you look back at my old tweets, I tweeted at Ryan Cohen several times to do that, and it was met with nothing. And then in May and June of last year, they raised billions, of around $4.5 billion of cash, right, via ATM offerings, because the stock started running, because Roaring Kitty came back out of the blue, and he started basically posting his positions again and posting massive amounts of of option open interest. And that meant that all these retail investors came back in, and GameStop took advantage of that by raising a bunch of capital by issuing equity. But then they sat on that cash for months, right? So from June 2024 to March 2025, they basically did nothing with around $4.6 billion in cash. And finally, in February of this year, Ryan Cohen had tweeted a picture of him with Michael Saylor. And so we were very bullish, like, okay, finally he's getting it. We've been tweeting at him. We even wrote a letter to the board. I did it with one of my fellow Twitter friends, Mozart. And we made all this effort, and it's fallen on deaf ears, but finally they got to it. They announced in late March, that they were going to be issuing a convertible bond. They were adding Bitcoin to their Treasury strategy, and they issue a 1.5 billion convert. They actually 1.2 with a 300 million green shoe option. They fill up the whole thing and oversubscribe it. They get a $1.5 billion. And then it isn't until the Bitcoin conference in late May that we discovered that they only bought around $500 million worth of Bitcoin with that 1.5 billion in cash. And they also bought it in May. So they bought it like above 100 or above 80 or above 85 grand when they could have bought below. So that was very disappointing. And I think so far a lot of the Bitcoiners have been really disenfranchised with GameStop because they thought that the stock was as sold on Bitcoin as the other Bitcoin treasury companies. And just the reality is that they're not. I wish that they were. I wish that Ryan would understand the thesis a bit more, but I think they see Bitcoin as more of an interesting side play rather than their core business, and that's fair. That's their decision to make. But as an investor, you should be aware of that they are not as a hardcore of a Bitcoin treasury company as others are. So if you want to make the pure Bitcoin play, I would go with others. I would obviously just go with Bitcoin if you want to be a simplest, but if you want to play the company side, go with other companies, because GameStop is just doing it kind of half-heartedly.
Yeah, I mean, to buy $500 million worth of Bitcoin and not have the conviction is it's hard. Because whenever you see Ryan Cohen on these interviews, he just seems like really, really bored and not too into it. So we'll see how that plays out. But it's definitely been an interesting part of this whole entire Bitcoin treasury company saga. And as we round out here, you, of course, wrote the dollar endgame. But you say that the answer to the dollar endgame is Bitcoin. So at what point are we in the dollar endgame, and how does Bitcoin play a part?
Sure. So I would say that we're already in the dollar endgame. And I would argue that the dollar endgame actually, obviously it began really in 1971 with Nixon leaving the gold standard, but it would really accelerated in 2008 and then again in 2015 when global central banks started or basically stopped funding the U.S. government on net. So one of the charts in my book is a chart of foreign holdings of U.S. treasuries. And you can see, foreign central bank holdings. You can see that from 2008 to 2015, foreign central banks bought 71% of net new issuance of treasury bonds. So meaning if the Treasury issued $10 trillion, they were buying $7.1 trillion. Then from 2015 to 2021, their net buying went down to 14%, meaning they were now buying only that 1.4 trillion of a net 10 trillion new issuance. And now it's basically flatlined. So if you net everything out across all central banks, although some are still buying, other central banks are slowly offlaying their bond portfolios. And so that means that overall central banks are no longer a huge funder. And that's very bad because central banks are a price insensitive buyer, meaning that they will buy no matter what. And they don't really care about losses on their book because they can obviously cover them up with paper money. They can print the difference. But every other type of buyer is price sensitive. So hedge funds, foreign family offices, sovereign wealth funds, those kinds of entities, they all care about where the bond price goes because they eventually have to liquidate the position. And that means that overall, the amount of funding that's been happening, especially on the long end for US Treasuries, has been falling off a cliff for the last few years. So one chart I show in one of my stealth liquidity pieces is a chart of the Fed balance sheet year over year broken down by maturity. So in that piece or in that chart, you see a huge spike during COVID across all maturities, meaning like the increase in 10-year bonds and 20-year bonds and 30-year bonds is huge, right? And then you see the taper start. So you see it go negative. So you see the bills being laid off. You see, the notes being laid off, the 2 years and the 5 years and the 7-year notes. But everything above 10 years doesn't get laid off by the Fed during a taper cycle. So when they're supposed to be restricting the money supply and rolling off these bonds and letting them expire and basically like deleting them from the system, they're not doing that for the long bonds. They're actually on net slowly increasing by, 10 billion or so a month. They're holding to the long bonds. So that tells you that the Fed understands they can't roll off the long bonds. They can't go out and sell them in the market because there's no demand. And the Treasury's been doing the same thing. Like we talked about Bessent with the stablecoin play. Yellen before him, and Bessent's going to continue, Yellen has been doing two things. One is moving issuance to the front end with the QRA, which is the quarterly refunding announcement, basically promising to do less and less long end issuance and moving to more and more short end issuance in order to, go to where the demand is. And she also was doing buybacks. And Bessent has been following suit. Just yesterday, I think they did around a 1.4 billion buyback, bringing the total for this week to 7.2 trillion or billion, or so. That's another way to add, stealth QE, stealth liquidity add. And the buybacks are mostly, again, on the long end because people just don't want them. So as the dollar end game continues, you'll see more and more entities start to lay off these long bonds and move to the shorter end. And then eventually you'll see it, like we said, an eventual run on the money, an eventual move of reserve currency from the US dollar to something else. And this has happened with the British pound. This has happened with, the Dutch guilder. It's happened with the Spanish peso. It's happened with every single reserve currency in history. It's just a matter of time. There's not a single one that can withstand Triffin's dilemma long term. But what all this means is whatever new currency that everyone moves into generally has to be better in some way, has to fix the problems of the old system. And Bitcoin is something that I pointed out is actually the perfect fix for the system because Bitcoin doesn't have a centralized issuing node, right? So it doesn't just ignore Triffin's dilemma, it solves it. Bitcoin doesn't need to be isolated to one country and face this balance of payments problems that every other country has to face, which causes these trade imbalances, which is, again, the reason why the U.S. has exported most of its manufacturing base and the reason why we import basically all of our goods and the reason why the Rust Belt has essentially, dilapidated and rusted into, nothingness, and Trump gained so many voters there in 2016 and 2024. Bitcoin is a new system that is peer-to-peer, censorship resistant, right? International in scope, immediate, extremely high fidelity, extremely high finality settlement. You don't need a centralized issuer, and you don't need to worry about tariffs or embargoes or any sort of trade issues impacting your ability to transact with the global economy. So Bitcoin's the true solution here, and I think that Bitcoin can genuinely save the world economy from a massive currency crisis.
I think that's a great place to end on. Roberto, thank you so much. If people want to find out more about the dollar endgame and your video content as well, where should they go?
Sure. So on Twitter, I'm at Peruvian_Bull, or if you just look up Roberto Rios, that's me. On YouTube, I'm just Peruvian Bull. Again, if you hit the search bar and just do Peruvian Bull Dollar Endgame, I have a whole series there. I also have a book. And then I write on Substack at dollarendgame.substack.com. The links are also in my Twitter bio. If you want to find more long-term or long-form macro research, you can sign up there. There's a free and a paid subscription. So either way really supports me. And if you're interested in learning more about macro, that's where I would go.
Absolutely. We're seeing more and more Banana Republic activity, and Bitcoin is your ticket out of it. And if you need a guide along the way, I think Peruvian Bull is a great one to do that. All right, everybody, thanks so much for tuning in, and catch you next week.